Does the market's recent weakness provide an opportunity for people to get more invested? Our next guest says most of his clients are still overweight cash and need to get back into the market. And he has some thoughts on exactly how to do so, both for stocks and bonds. For more, let's bring in Thomas Kennedy. He's the chief investment strategist at JPMorgan Private Bank. So your decisions, Tom, probably touch on what's going on with a lot of people's money these days. It's good to have you. Welcome.
Thanks for having me, Kelly.
And what would you say this boils down to? Trying to coax people out of cash still?
Our community, which is one of the biggest pools of wealth assets in the world, is still heavily overweight cash. So the rally that we saw in November and December has created a challenge for people to get reinvested. And we're calling it the everything rally. After the everything rally, what do? In November and December, you saw stocks and bonds outperform generally what you would have expected the S&P 500 to give you in an average year, Kelly. So it is a challenge to get people over the hurdle, but I think there's opportunities in stocks and in bonds to really get there.
What are the best ways to do so, you think, as you look around the universe?
Relative to what's in the price, at the broad level, high level, I think the market has priced in a soft landing almost perfectly. If you and I were sitting here, Kelly, say 6 months ago, what should the market price for Fed cuts in a soft landing? I think the average person would say roughly 200 basis points over a year and a half. That's what the market has right now. So I think for the bond market, the easiest thing to say is rate cuts are coming and that cash yield is going to go down. I can move out the curve just a little bit and maybe lock in a 5% yield. I think that's the easiest trade to make. But really what we really need our clients to get to do is to get some more capital appreciation, be ready for the next bull market in equities. Yes, the S&P 500 is trading at PE multiples higher than historical averages, but small and mid-cap stocks trading relatively cheap. And that's where earnings growth should accelerate the most with a better economic backdrop for 2024.
Let me ask you one more about that, because that's a really interesting point. But I think a lot of people who are on the sidelines would think to themselves, OK, do I hold my nose and just kind of buy the S&P 500 even though it's gotten away from me because it's typically the outperformer? Or do I go for something where there's maybe a little bit more quote unquote value, but it might lag over time, which my sense is maybe that small and mid caps do, but maybe I'm wrong about that.
I think the historical backdrop, Kelly, important to recognize is small and mid-cap stocks tend to be the most sensitive to growth. And in the last 12, maybe even 18 months, interest rates have been the dominant driver. And as interest rates have come down, you've seen tech shares really snap back quickly. Price to earnings multiples on small and mid-cap stocks are cheap, one, maybe two turns cheap, depending on what you're looking at. But as growth accelerates or gets repositioned for higher expected earnings next year, we should see small and mid caps outperform, at least tactically. The thing that's important for my clients is they're underweight this sector. And yes, I agree, getting beta is an easier opportunity set. But if we do get that firm soft landing, which we're expecting in our baseline, small and mid caps should outperform better.